The yellow line is the Fed's balance sheet and the red line is the Dow Jones or the US stock market. And whenever the Fed reduce its balance sheet like this or quantitative tightening, the stock market went pretty crazy. And Fed just reduced its balance sheet again in March 2022 till now. And how will the market react this time? In today's tutorial, we will discuss what is QE and QT and their impact to the stock market. Lastly, the latest QT. Down here, how will the stock market react this time? My name is Con Hao. My work in this channel, as always, is to study into the correlation between the markets and uncovering potential opportunities. And before we discuss about this topic, please do take some time to read into the disclaimer. What is QE and QT? QE is a quantitative easing. In short, is the printing of money. And QT is quantitative tightening, meaning the opposite. Now, let me just elaborate on the QE. QE involves central banks buying government bonds to increase the money supply and lower interest rates, thereby stimulating economy. And this is what we see here. That's called QE, and we could see that the market went up. And how about QT? Now, QT, on the other hand, is the process by which a central bank reduces the money supply and raises interest rate by selling or allowing maturing assets on its balance sheet to expire without replacing them. This is typically done to cool down an overheating economy or combat inflation. Let's go over to the second segment here is QE and QT impact to the stock market. And let's discuss about QE, quantitative easing, which is increasing money supply where stock market should go up. And a very typical example will be during the COVID-19. That's where the Fed increases balance sheet, or QE, when QE happened and it's almost certain that the stock market went bullish. And that's what we're seeing here. And let's look at the QT. And again, QT is a reduction of the money supply. So stock market will go through a period of maybe bear market or huge volatility. And let's recap what happened to 2017 and the Fed go to QT briefly for about 2 years. And let's look at what happened to the stock market at the beginning of 2018 with QT. The stock market or the Dow Jones or NASDAQ or S&P went into a period of huge volatility to the extent of almost going to bearishness. And thanks to QT, the market went up. How about we take a closer look at the QT down here? And with all the different QT, and of course with the very famous QE123 in 2008, and right before that, market went into a bearish mode, and that in a way it was QT, and we could see that in every QT, the market went into a bear or into a huge volatility. And let's recap again that the QT started at the late of 2017 or the beginning of 2018. And that's what we saw. And in 2018, the whole stock market went into a huge volatility. As we could see here, that's a huge volatility. And we are saying that the stock market went into one huge volatility like this. Okay, yeah. And let's look at what happened to the recent QT. And we saw that the Fed went to the shrinking of balance sheets beginning March 2022. And that's where they also started their increase of interest rate and in the same time reducing its balance sheet. And so far it has reduced down by about 1.3 trillion US dollars. And that's quite a bit compared to this. And what we're seeing here that I'm suspecting that the whole market may enter into a period of huge range and maybe it's just at its beginning. And that's what I'm seeing here. Could it be with the beginning of QT again, are we expecting to see this? Maybe it could be. And what I'm suggesting here is that it's just a mirror of what we're seeing here is that 1, 2, 3, 4. Are we enter into the mode of seeing this? We're just part of it, maybe. 1, 2, 3 in the making, maybe 4. I'm not suggesting that it's going to mirror exactly the same, but could we be having this a period of huge volatility, but in a more magnified way? Why? Because the balance sheet, the strength of balance sheet is much more compared to the past in 2017. And that's what I'm seeing here. And let's go and look at, in this context, if I were to be a bit cautious, maybe to hedge and trade, we are expecting that the years to come, months to come, maybe into 2024, that there'll be huge volatility coming up. And immediately, what I could see here is that maybe before it hit on the upper range, I'm seeing that there could be an immediate resistance pretty soon. It could be here and it could be here. It doesn't matter. So I just rest it here first as an indicator. So of course, we saw that this week there was a good news where CPI came down to 3.2% and the Dow Jones rally. NASDAQ, Dow Jones, all over the stock indices rally. But I could see that there's an immediate resistance around here. And if it ever broke above, that means the next resistance is further up. But I'm watching it very carefully, a bit hawkish on this. If it ever resisted here, I may take profit or even turn short. With conclusion here is that many investors may be thinking that if economy goes into a recession and a bear market, the Fed can always roll out its QE again. But can I say this, that this time it is very different situation. We are in a very different situation. Why is it so? Because with inflation pressure still not exactly over yet, having to restart another round of QE again, which is to increase the balance sheet again, what is the harmful effect? It may just make the inflation situation worse off. Because we have to understand that because of the past QE, it leads to today's global inflation. So it's almost impossible for Fed to go back to its QE campaign again. And the market is always telling us on their next move. Join us in our weekly case study and discussion. Click on my profile icon to find out more. Feel free to leave any comments below. I'd love to exchange ideas with you. Really happy that you stayed through this tutorial. You have many great trading weeks ahead.